Are you a risk-averse investor? If yes, then today's conversation is all for you. As we are going to speak about passive investing, how to diversify and reduce concentration risk in your passive investment. To discuss this, we have on board Aditya Shah, Chief Investment Officer, JST Investment, joining us now. Aditya, good evening. Thank you so much for joining. So the question and the topic that we are taking up today is how to diversify and reduce risk in passive investment. But tell me something, if you are a financial planner, would you recommend a person to have an all passive strategy?
First of all, ma'am, if I'm a financial planner, I will never suggest to go either 100% active funds or either go 100% passive funds. I will suggest a mix of active and passive funds. What really happens is when you bet on a simply a passive portfolio, you are betting that no fund manager will be able to outperform the market. That's not really the case. We have seen across the flexi cap category, about 90% of the funds outperform the index. So in my opinion, there should be a mix of active and passive funds. On the large cap side of it, you should always go with the passive funds. On the flexi cap side of it, and maybe on the mid cap side of it, you can look at some active funds, but never put your eggs in one basket, as Warren Buffett says. Both active and passive funds. Just on the large cap category side of it, stick with passive funds. On the flexi cap side, stick to active funds.
So, since passive investment of passive funds are gaining momentum now in the country, tell us the kind of variety that an investor has.
On the passive fund side of it, we have the large cap passive funds, which is the Nifty 50 index fund. Wide varieties of mutual fund companies offer this fund. It is a large cap fund which has top 50 companies in this country. Then there is a mid cap passive fund which is called the Nifty Next 50 fund, which has the next 50 companies that are going to be included in the index. It is a sort of a mid capish company portfolio that is out there, and it is again a passive fund that is there. And then we have some mid cap 100 passive funds that are available, given by various companies like Motilal Oswal, etc. They are also a sort of passive funds as well. And then a new line of passive funds are also getting developed. For example, Nifty 50 equal weight index passive fund, where all 50 stocks in the Nifty 50 are given equal weight. So that is another kind of passive fund that is available. In all of these passive funds, there are two things that are very important that you should be looking at. One is the expense ratio, and one is the tracking error, the error that they are giving with respect to the index return. These are the two things that you need to really monitor when you go ahead and invest in these index.
Tell us something now, since you said that you wouldn't recommend an all passive strategy to an investor. So, in what scenario one should be considering a passive route in their investments?
If you're a completely large cap investor, we have about 85% of large cap funds completely underperforming the market over the period of 10 years. 10 years is a very long term horizon for a entire portfolio or entire universe to underperform. So entirely large capish if your portfolio is, then you must not invest in any other thing than an index fund. Who are these investors? Those who are in their 50s and 60s, who are not looking for too much of risk in their portfolio, they can go ahead and invest in all passive fund portfolio. However, those who are young, who can take extra risk in the market, who can tolerate a little bit of underperformance, they should go for an active and passive kind of a strategy. But never leave any of these strategies out of your portfolio, because today, as a financial planner, I don't know will the passive fund strategy outperform or the active fund strategy outperform. So it is better to keep your leg in both the baskets, active as well as passive.
If you're talking about large cap, why is the right time to have a passive strategy instead of an active one?
Ma'am, this is the BSC SPIVA data that has come up over the last 10 years. Nearly 85% of the large cap active funds have underperformed the market. It's a huge amount of mutual fund schemes that are underperforming the market. So it makes better sense for an active investor who's investing in large caps to go ahead and invest in index fund. What really happens is, as SEBI categorization has come up since 2018, large cap funds are not allowed to invest in the mid cap fund to generate extra alpha, in the mid cap stocks to generate extra alpha. And because of this, the extra opportunity to create alpha is diminishing out. and these funds carry 1% expense ratio, whereas an active fund would carry a 0.1% expense ratio. So in my view, the active fund underperformance in the large cap category will continue. Therefore, it is much more important to switch to an index fund. If you are invested in an underperforming fund, I will suggest stop the SIP, start investing in an index fund, and slowly get your corpus out and invest in index.
Going through the passive route for international investment, should that place be given for this in your portfolio?
Definitely. Passive funds in an international context makes a lot of sense. I have constantly been recommending the Motilal Nasdaq 100 passive fund. It's a passive fund where it follows what the index fund is really doing. So there the expense ratio is again cut out. You are not investing with a fund manager whom you don't know at all. You are investing with an index. So in my view, all mutual fund companies are now getting the Nasdaq 100 ETF, which is an excellent product to invest in. Some are getting the FANG ETF also, and other products are on the active side are also available. But in my view, Motilal Nasdaq has outperformed the market over a time horizon of 3 years. It will continue to do so, and I personally choose passive index strategy for international investments because they are the best ones to do so.
A lot of times, these heavy jargons, that they put on investment products, confuse investors, Aditya. So this time, what's happening is passive funds or passive investment instruments are also being called as smart beta products. Can you simplify and break this down for the viewers?
And what really happens is there are smart beta products available in the market now, something like a DSP quant fund. So what happens is they don't have an active fund manager. However, they are driven by some rules, and those rules decide when to buy or sell a stock. It is a strategy to create higher alpha as compared to an index fund, and that's why they are called higher active beta strategy. In my opinion, a pure play or index fund strategy works really well. For those who are looking for some higher return above the index, these strategies are best. However, let's not confuse ourselves too much. For an average retail investor, an index strategy, be it a Nifty 50 strategy or a Nifty Next 50 strategy or a Motilal Nasdaq 100 are sufficed for their equity investment.
So now tell me one thing, a lot of millennials and the new investors enter the market, okay? I mean, it's a good trend that we are seeing since the pandemic now. And what would you recommend for a new investor? How should they diversify keeping a passive strategy in mind? Because a lot of time investors do is they put more trust on the investment being cost effective. Should that be the criteria to go through a passive route in your investments?
Investments being cost effective is just one of the parameters. There are several other parameters that one needs to watch out before they start to invest. If a millennial is just starting their investments, I will suggest a passive fund should be 20 to 30% of your portfolio. 50 to 60, maybe 70% as well should be active funds. Go after the flexi cap funds. Flexi cap funds offer huge and good returns over a period of 5, 7, 10 years. We have seen, for example, the Parag Parit fund, flexi cap fund did 21% return over a period of the last 5 years. So our flexi cap fund will work. A mid cap strategy will also work since he's a millennial and he's just starting off his investments. 20 to 30%, not more than that. I will use the international index funds or international passive funds to build a passive fund exposure and a little bit of large cap exposure since the risk tolerance will be high as the person would be young. So in my opinion, 60 to 70 in active, 20 to 30% in passive funds. Use passive funds to build international exposure and a little bit of large cap exposure.
All right, so that's all if you want to opt for a passive strategy in your portfolio. But we have few questions also asked by our viewers, Aditya. The first question comes from Punit Chadda, and I'll just tell you the funds that he has in his portfolio. He has Axis Long Term Equity, ICICI Pru PhD Fund. He has Kotak Nasdaq 100 Fund and SIP of 1,000, 2,500 each. Also, he has ICICI Pru Blue Chip Fund fund, Mira Asset large cap fund, and Axis mid cap. Now here he's investing 1,000 in ICICI blue chip, Axis mid cap 1,000, and Mira Asset large cap he's investing 2,000 rupees per month through SIP. Now he wishes to accumulate 1 CR in 15 years, and he just started his investment journey in Jan. So the overall investment amount would be 1, 2, 3, 4, around 8,500 SIP going on every month. How are the funds, and is this amount enough for 1 crore corpus in 15 years?
First of all, the amount is not enough. The investor must do an SIP of minimum 15,000 to achieve his goal. Since the investor is starting young, I will suggest try to increase your SIP minimum by 10% every year. If that is not possible, try to elongate your goal. Instead of 15 years, try to make your goal to 20 years. Then you may be able to reach your goal. The second point is, as I already said, the investor has got large cap active funds inside his portfolio. They are not good and they will not perform or beat the benchmark. In my opinion, the blue chip fund and ICICI blue chip fund and the Mirai large cap fund, he needs to switch them over to UTI Nifty 50 index fund, because index funds are better option in that universe. The investor does not have a flexi cap fund. Investor can go ahead and invest in Parag Parikh flexi cap fund. It's a good fund, good fund managers are out there, and the Nasdaq exposure is good enough. So two funds need to change here. One is the large cap exposure needs to be changed, and flexi cap exposure needs to be introduced, and the SIP must be increased as time goes.
Next question is from Ram Kisan Verma, and he's 40 years old and he wants to accumulate 3 crores, and he says that he's been investing 5,000 rupees in Motilal Oswal Mid Cap 30 Fund and 3,000 in Kenro Robeco Flexi Cap Fund. SIP tenure is around 20 years, and he's going to top up by 1,000 rupees in both the funds once in a year, it seems, and he wants to understand if the fund choice is it aligned as per his goal.
First of all, ma'am, the Motilal Multi-Cap 30 Fund has underperformed for a while, and then it has done very okay. I will suggest to switch off from that fund. Parag Parikh Flexi Cap Fund is a very good fund, and the Canara Robeco Flexi Cap Fund is also a good fund. If you are able to invest in these two funds and also introduce the international funds, which is the Nasdaq fund, Motilal Nasdaq 100, these three funds would do the job for you. 3 CR at this kind of an SIP is again very tall order to ask for. You are asking for very high returns from your investments. Again, the same advice for this investor as well. As you have said that you are going to top up the SIP, try to top up the SIP aggressively in the next few years, so that what happens, the effect of compounding can be seen in the next 20 years. Since I am saying that your age is 40 years and you will have 20 years of investment in funds. So increase your SIP, try to switch to Parag Parikh Flexi Cap Fund, have a international exposure from the Nasdaq funds, and you should be good.
All right, so these were the queries from our viewers.